Welcome to TheoTrade. This is Don Kaufman. It's August 29th, 2018. You are watching the Theo Night video. Let's get right to it. Just moments after the close, well, the S&Ps and the Nasdaq specifically are set ablaze to the upside. Again, just to kind of highlight the marketplace as a whole, the S&P is up another 0.5% into all-time new high territory. The Nasdaq kind of set ablaze another 1%. And really, all of this kind of momentum inside of both the S&Ps and the Nasdaq, I want to be real specific with this one, is coming from Google, Amazon, Apple, okay, Microsoft. So we have kind of lovingly named, all right, what we term the monsters of tech. Now, the monsters of tech, of course, includes Facebook, Apple, Microsoft, Google, Amazon, but it really is. It's the monsters of tech, and this is kind of a ratioed symbol that we put together, oh, wow, about almost 2 years ago now. The monsters of tech aren't just outperforming, they're exploding to the upside. And one of the things that I've been talking about extensively lately is, you know, how does a bear live in a marketplace that's ripping to the upside? And the answer is, well, look at some of the positions that we happen to have on lately. One of those including, of course, the financials. And we can only sit back and be thankful at this point that we're not in one of the sectors that's exploding to the upside. So I look towards the financials because it's extraordinarily rare to see this kind of a movement. And what's this kind of movement? Well, the S&Ps are up a full 0.5% without any involvement of the financials. Now, the financials, everybody says, again, tech's the largest sector by far and away. And by market cap, they technically are. But the financials are an absolute behemoth. And there's actually a number of tech stocks that are in kind of the tech sector that are impacted by movement of the financials. Nevertheless, the financials are utterly unchanged with the S&Ps up 15. And I want you to note that one. Why? Because it doesn't happen but a handful of times in the last several years of trade. I went back and actually did some regression analysis on that one. Again, extraordinarily rare. If I get into specifics, you can see that I'm carrying some positions inside of the financials, hence why I'm a little thankful the financials didn't necessarily break to the upside. But also one of the positions that I've recently put on has everything to do with JP Morgan. JP Morgan, ironically, has actually backed off the last 2 days of trade. Another one of the key positions that we've put on lately happens everything to do with the XRT. And again, regardless of what you're looking at in terms of the markets breaching into new time, and all-time highs and, new highs day in and day out, we're in a couple of positions right now that are actually working for us. And that is, again, one of the most important aspects is we've been very, very sector specific in light of some of the activity in recent markets. All right, let's completely switch gears, and I want to cruise over to the SPX in tonight's video. And one of the things that's, I think, the big standout of the recent activity that we've seen, and I'm going to kind of zoom in for just a second, because what you're looking at on the screen right now happen to be the week over week moves. These lines simply represent expected move. Kind of week in and week out, we draw expected moves. Lately, the expected moves have been, like this week, they've been right around $31. The week before is about $32. The week before that was about $42. Then we had about a $32 expected move. And again, just kind of expanding and contracting. But one of the things that kind of stands out on the screen is the relative lack of occurrence. Okay, there's no occurrence here, there. We did crack outside of the expected move, back inside. What I'm getting to is we have only had, one recent breach of expected move where we stayed outside of the expected move by week's end. Clearly, we've seen several breaches of expected move, but there's only one instance, recently where we stayed outside of expected move. Now, we can actually zoom back to the beginning of the year. The beginning of the year was an incredible, array of what we term inefficiency in the marketplace. Outside the expected move, outside the expected move, outside, outside the expected move, outside it. Week in and week out, we were smashing through it. Now, assume that when you're starting to crack through what was expected, first of all, the option marketplace is doing a terrible job of pricing risk. Because I'll give you an example. If the option marketplace, like this particular week, was pricing in, for example, a $23 expected move, and the actual move, let's say, was $35, okay? The options marketplace did everything wrong. And that's what you were seeing early on in the trading year. It's actually, again, what I'll term a period of inefficiency in the marketplace. All right, so now you zoom in after that little bout of volatility. You zoom into many of the recent months. And again, we're coming now into April. Okay, so April, we've got May, June, July, August. Again, April, May, June, July, August. You've got 5 months. All right, 5 months. Mild breach here, mild breach here. This one, I'm not even sure. That might qualify as a rounding error. You have 2, maybe 3 breaches, okay, in 5 months. And you just do this like kind of on the surface, some quick and dirty math on this front. When I say like just quick and dirty math, all I'm actually saying is if you kind of respect the expected move over, okay, the last 5 months, let's say the last 5 months, if you want to break it down, it's 5 months. We'll call it like an average of about 4 to 5 weeks in a month. So let's say we had a total of about 24 weeks that we passed through, okay? Only really 3 out of 24 smashed through the expected move. So anytime that we see a breach that's this substantial, you got to kind of ask yourself, are we about to move back into a period, okay, of wild inefficiency in the marketplace? Okay, you also have to respect the fact that this happens to be coming into a holiday week. You wouldn't expect this kind of activity on a holiday week. In fact, there's a couple of trades you can do on this front. So first and foremost, many of you that kind of tune in on a day-to-day basis, you know, again, I look at the expected move in extraordinary amount. If you're not comfortable with the SPX, you can cruise over to the spiders. The spiders just might be a softer, gentler way for you to take a trade. Now, if you thought that the remainder of this week was going to see this kind of continuation, and again, this kind of continuation, it's at the point of unprecedented. The spiders have just taken off to the upside from the 286 291. Just bear with me for a second as you look at this on a percentage basis. All right, just the last 4 trading sessions. The last 4 trading sessions have actually seen, okay, over close to a 3% move up in markets. I mean, again, there's some fairly staggering stats in play right now. But at this point in time, do you believe that the expected move, okay, is going to be continually breached or come back in? And as I said, there's kind of a number of trades you can take on this front. You could look towards, all right, what we term a ratio back spread. If you thought we were going to continue to explode higher, okay, just over the next 2 days, you could do a little bit of a ratio back spread. Now, this ratio back spread, it's selling an at-the-money option, buying 2 of the out-of-the-money options, selling 1 of the 291.50s, buying 2, okay, of the 292.50s. It's for a 10-cent credit. So in effect, the way that the trade effectively works out here is if this is the marketplace and the marketplace tanks, you get to keep the 10-cent credit. If the marketplace goes and continues up, there's going to be a dip and then a rip. And this is what the risk graph would kind of break down to. And I've been playing around with a couple of different trades in here, but this is exactly the risk graph that we talked about. Now, again, you'd have to have an explosive move continuing all the way above 293.40. Now, I'm not one to get bullish per se on a marketplace, but this is right here, to me, this is a great way to hedge your risk. If you got risk to the upside and you're getting eaten alive in a marketplace that's been relentless like this, this might be the trade for you. Now, that's if you think that we're going to continue to blow through the upper edge of the expected move. Now, for just a moment, I want to go back to the SPX. Again, the edge of the expected move happens to be none other than, let's actually put that in numerical form, none other than 29.05. So that's the edge of the expected move. The other trade that you might want to employ, and in this case I'll use the SPX, is there's a lot of times where we said, well, hey, listen, we expect us to move back inside of what was expected. Now, normally I'd like to sell some premium around that, but how much premium can I sell with 2 days left? And really, the at-the-money option has 6% implied volatility. So, listen, that chicken is done. That ship has sailed. There's no premium to sell. I think a little bit of a higher risk position. And this is kind of an either or. Either you're doing the ratio back spread because you think we're going to explode to the upside, right? Or you come around and say, well, you know what? I think we're going to be back inside the expected move. Now, I like to take positions like this. This is a $5 wide spread for a $2 debit. Okay, this particular position, and we're going to look at this one, happens to be none other than just a straight in-out spread for 2 days. All the in-out spread says, okay, doesn't even scream it. All it says is that I believe that we're actually going to be back in and around that edge of an expected move. Again, in and around the edge of the expected move. Hence, taking a bit of, again, it's not so much of a bearish stance in the marketplace. It's more of a, let's move back. Let's migrate back to the edge of the expected move. So there's two positions that can take you into, again, this kind of holiday week and what has been an unprecedented move to the upside. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.